What's going on, my fellow wealth creators? Matty Ice here. In this video, I want to share what I believe is the best alternative to indexed universal life insurance. And I would strongly encourage you guys to at least investigate this, weigh the options, potentially do this instead of IUL, because that great promise of IUL to get upside potential downside protection in the market, did you know you can get that with a whole life policy and avoid all the risks, all the problems involved with IUL? You can. That's what this video is about. Because I almost purchased an IUL. I drank the IUL Kool-Aid. It sounded like the best thing since sliced bread. It sounded like this. They make it sound like this this magical unicorn financial product that's going to solve all of our problems, eliminate market volatility. You know, we'll never lose money. I've heard plenty of agents say that, which is not true. They also show us getting this, receiving this ridiculous, highly unrealistic amount of tax-free retirement income. It's not going to happen. And all of the risks, all the things that can go wrong with IUL are swept under the rug. They only tell you about how amazing this product is. And if anything negative comes up about it, oh, it's not a big deal. You know, we don't need to worry about that. Okay. Yeah, not so much. You do have to worry about it. And we're going to talk about some of those risks in this video. But I want you guys to know that there's an alternative. So if that promise of upside potential downside protection is attractive to you, you can get that with a whole life policy and avoid all the problems of IUL. And for me, at the end of the day, what matters most to me is that you make an informed decision, that you have all of your options, you have all of the information, you know how these products work, so you can make the best decision for you. If it's still an IUL, great. If that's what you want to do and it's an informed decision, I don't care. The biggest problem I have with IUL is how it's marketed, presented, sold, illustrated to people. Because again, all the risks are swept under the rug. People don't actually know what they're putting their money into. They're making these life-changing financial decisions without having all the facts. And a lot of times, I don't even think the agents selling it truly know how the product works and the risks involved. I hear agents all the time. You say you can never lose money, which is a lie. You're going to get 8 to 10% compound growth in an IUL. That's a joke. It's all based on smoke and mirrors. It's all based on how sexy the illustration is. Well, I got news for you guys. Life doesn't happen on a spreadsheet or an illustration, as one of my mentors would say it. Okay, it can look really good on paper, but what's actually going to happen in reality? And when you understand how IUL works, the numbers you see on the illustration all of a sudden don't really make sense, right? And that's my biggest frustration with IUL and why I really want you guys to know that there is an alternative if you want that upside potential downside protection. Okay, so let's get into it. Let me go ahead and share my screen. All right, so I have a little presentation here. I'm not going to go full screen mode. I hope that's okay because I have other resources and tabs that I want to show you guys as we go through this. But let's have some fun. All right, so do this instead of IUL. This is what I believe is the best IUL alternative out there. All right, so we already asked this question. Did you know you can get upside potential downside protection in the market with a whole life policy? You can, without all the problems that come with an IUL. How do we do that? Okay, it's called an indexed dividend option rider. All right, I'm going to explain exactly what that is here in a minute. As of right now, there's only 2 companies that offer this. As I record this, at least that I'm aware of, it's Guardian, which is one of the top 4 mutually owned life insurance company, very popular, very strong products, and also One America. Now, I actually prefer One America. I set my second policy up with One America, but I prefer One America because they don't charge a fee for this rider. As of right now, to my knowledge, Guardian does. That might change. All right, so you can talk to somebody that works at Guardian as well to double check. But I think this is one of the reasons that this is not a very well-known strategy or option, I should say, because there's not there's only 2 companies offering it, right? Which I don't really understand why. It's a pretty simple strategy when it comes to adding it to a whole life policy, as you'll see here in a minute. But it is what it is, and I think but at the end of the day, I think that's why a lot of people don't know about this, is because it's not highly promoted. And it kind of makes sense to me because, to be quite honest, I am not a big fan of involving the stock market with my whole life policies. I want to talk about this for a second. We'll go back to the presentation. I'm not really a fan of the stock market at all. And I'm not saying to not invest in the market. I'm not saying to not do the indexing strategy. Okay. But I think that might be why it's not promoted as much, is because whole life insurance is, when you think about that, when you think about whole life, you have the guaranteed growth rate and dividend. That's usually how whole life works, right? And probably how it should work. So it's just not it's not as popular, I guess. And not to mention, you have tens of thousands of more agents selling IUL than whole life. Also, you got me and my little YouTube channel trying to tell you about this in the midst of all the IUL propaganda right now, right? So, there's not too much information on it out there. So, I just wanted to bring that up as a side note. I'm not a huge fan of involving the stock market in my whole life policy, but if you are going to do this, I would much rather see you do this with a whole life policy than an indexed universal life policy, because there's far less risk involved, guys. All right. So let's break down exactly how this works. All right. So this is a simplified version or simplified breakdown of how this particular rider works. The multiplier and maximizer used are subject to change, just like cap rates, participation rates, spread charges, those kinds of things can all be changed inside of an IUL. Well, the multiplier maximizer used to determine the amount of dividend to be credited to your cash value in the policy, those can change. Okay, and I'm gonna show you an example of exactly what that is, the multiplier and maximizer, because essentially what we're doing here is potentially doubling our dividend. That's where the extra growth comes from. Okay, and we'll get into that in a minute. All right, but here's a breakdown, 4 steps of how this works. We have the dividend earned. Okay, so the dividends each year is technically a return of premium, which I'm going to show you a flyer on that in a second on how the dividend actually works. It's not like I'm just getting my money back because they overcharged me. That's not what's happening. Otherwise, a whole life policy wouldn't grow. I wouldn't have more cash value in my policy than what I put in if they were just giving me my own money back. All right. So, but because One America is a mutually owned life insurance company, participating policies pay a dividend to their policyholders. Okay, great. So they declare a dividend every single year. And the next step is going to be the dividend allocation. Okay, so we actually, with this indexed dividend option rider, we get to choose how much of our dividend to allocate to this indexing strategy. We could allocate all of our dividend. We could allocate half of our dividend, 25% of our dividend, whatever. It's totally up to us on how much we want to allocate to this indexing strategy. If we did a 50% allocation to this, then the other 50% of my dividend would just be credited to my cash value like it normally would. That's what's happening with the allocation. Okay. Next, step 3 is the indexing strategy. The dividend that we allocate to it is then used to purchase call options on the S&P 500. So this is very similar to how an IUL works, where the general fund creates an options budget, and then they use that budget to go purchase call options. And then depending on how expensive the call options are, that is going to, so number one, it depends on what the options budget is for that year, and then also how expensive are call options. And that's going to dictate what the participation and cap rates and spread charges are, like all those things that can change in an IUL. It's a lot of it is based on the options budget and the cost of call options. All right. So in this indexing strategy, the company's going to use the dividend to go purchase call options on the S&P 500. Now, what I love about this is right now it's just the S&P 500. There's no other index that you can choose to utilize this strategy, which I actually really like. I don't want to be a money manager, guys. And when you're buying an IUL, there's just tons of different indexes that you can choose from. You could put 25% here. You could put 50% here. I'm not interested. If you guys want to go down that rabbit hole, be my guest. All right. But the S&P 500, if you look back over however many years, has done really well. A lot of the times, I'm going to get a little off track here for a second, but since we're talking about the S&P 500, most fund managers, hedge fund managers, whatever, advisors can't beat the S&P 500 on a consistent basis. So my question is, Why on earth would you pay somebody to manage your money who can't beat the S&P 500 when you can just go buy the SPY index and the fee is only like 0.09%? You can go buy SPY in your brokerage account yourself and then just let that thing ride. I don't know. I digress though. But I like that they only offer this on the S&P 500. You don't have to worry about what index to choose. You don't have to worry about all these ridiculous proprietary indexes that these IUL companies offer, which really the only reason they do that, one of the primary reasons anyways, is to mitigate the cost of call options, because the cost of call options on S&P 500 can be expensive. It fluctuates, etc. And those costs can be controlled more with proprietary indexes. The problem is they suck. When you look at the actual performance of these proprietary, other proprietary indexes, they suck, most of them. And they haven't even been around that long, guys. And you're going to bet your financial future on an index that's only been around for 5 years? No, thank you. Have fun with that. So, indexing strategy. They buy the call options on the S&P 500, and then the crediting breakdown, the amount credited to our policy, basically our dividend, is based on a multiplier and a maximizer. All right, so I want to show you that right now. Okay, and actually I meant to show you the dividends breakdown as well. We'll do that later. That's not a huge part of this video, but anyways. This is actually a consumer flyer from One America about the index dividend option. So if you guys want to get this, let me know. We can set that up. But it's just breaking down what the index option rider is. It offers us the potential to increase our dividend up to doubling it. That's the most that we can, like the increased potential. It's just double our dividends. All right. Let's see. And it's based on the performance of the S&P 500, potentially double it every year. It's not going to happen every year because the market doesn't go up every single year, guys. In a down market year, your dividend will never be negative. So your account or your cash value can't go backwards because you still have the guaranteed growth, which with One America is 3.25%. Right. Now, I want to stress that doesn't mean your cash value is going to grow by 3.25% every single year. That's a net. That's a gross number. We'll get into that later. All right. But I just want to be clear on that. The risk involved with this strategy versus IUL is the risk is you lose your dividends, or the amount of your dividend that you allocate. You can lose that. However, your cash value can't go backwards. You still have the strong guarantees of whole life insurance. That's one of the biggest differences with this strategy, guys, is when, let's talk about this for a second. This is really important, guys. When you hear people say that you can't lose money in an IUL, you won't lose money in the market. While that part is true, you can lose money because the market goes down, though, because there's still costs and fees associated with your IUL. The other problem with IUL, or one of those costs, is your cost of insurance. It's built on annual renewable term. So when you take all those fees, costs, etc., where does that come from? Well, it comes from your cash value in a 0 year. So you might not lose money in the market, but because the market didn't go up or went down, your cash value is going to go backwards. Your cash value is going to go down because your cash value is covering the cost and fees of the policy. That doesn't happen in a whole life policy, guys. Your whole life policy is guaranteed to grow every single year, right? That's just how whole life works. So when you're using the indexing strategy with a whole life policy, the only thing at risk is your dividend. And if you're okay with that, then it could be a really, really good strategy for you. But don't listen to people that talk about that want you to buy an IUL saying that you can't ever lose money in an IUL, or that you can't lose money in the market. You can't lose money in the market because you're not technically invested in the market, but there are cost, fees, etc., with the policy that will be deducted from your cash value if you have a 0 year. Just keep that in mind. All right, back to the presentation. So I want to show you an example here. This is just a hypothetical example that they provided. And right here is where we get a definition of or an idea of how the maximizer rate and the multiplier is used within the policy, okay, within the strategy. So based on dividend maximizer rate of 10%, right now I think it's 12%. What this means is that in order for us to double our dividends, the market needs to do at least 12%. In this example, it's 10, but like I said, that part can fluctuate. The market, the S&P 500 needs to do at least 12% or more to double our dividends. Okay, that's why the maximum multiplier is 2, doubling. Okay, now what if the S&P 500 does not go up 12%? Let's say it goes up 8%. Well, based on the multiplier, it might be, based on the maximizer rate, that multiplier might be 1.7 times your dividend or 1.5 times your dividend. It just depends on how much the S&P 500 goes up. Here's a couple of examples. All right. So in year 5 here, we would have received a $4,000 dividend. Instead, we received a $2,000 dividend because the market only went up 2.5%. Okay. In year 6, the market goes up 8%. We would have received a $5,000 dividend. See here, no IDO allocation. That's indexed dividend option. Okay. But we did 100% in year 6. So the market went up 8%. We earned an $8,000 dividend. So we earned an extra $3,000 on top of our original dividend. Now in year 7, market goes down, right? We would have received a $7,000 dividend in this example, but we received nothing because we allocated all of our money to the call option strategy. All of that money was lost because the market went down. However, we didn't lose any cash value. In fact, our cash value still grew because we have the guarantees of whole life. If you have an IUL, every 0 year, you're losing money. You're going backwards. Most of the time, I know that some IULs offer like a 1% floor, 2% floor, or something like that. Just know that you're giving something up in the back end for that, guys. And also, that doesn't mean that your cash value won't go backwards, that you won't lose money, because if that 1% floor is not, interest credit is not enough to cover all the cost of insurance and additional fees, you could still go backwards. Maybe not as much because you have that 1% interest credit floor, whatever. But you could still go backwards. All right, just keep that in mind. So, but this is also why I'm not a huge fan of involving the stock market with my whole life policies. I'd rather get that uninterrupted tax-free compound growth with the dividends and stuff, and use my policy to build wealth and make investments like I normally would. Maybe I'm not investing in the stock market right now, but again, it's totally up to you. Now you can see in year 8 though, we really make up for it. Because in year 8, the market goes up 14% and we doubled our dividends on this year. So we would have received a $10,000 dividend. Instead, we received $20,000 dividend. That's pretty sweet. So this strategy, I think, could actually be even more attractive on a more matured policy. So 5, 10, 15 years old, where the growth is really starting to kick in. Okay. And as those dividends get bigger, your potential return gets bigger, right? Like comparing a $4,000 dividend to a $10,000 dividend. Well, I'd rather get these dividends right here, really build up the cash value and make it worth it, in my opinion. And then when I'm getting $10,000, $15,000, $20,000 dividends, maybe now, based off of the research I've done, in the market, whatever, I think the market's going up, maybe I turn on this indexed dividend option rider. And the next year, I get a $40,000 dividend instead of $20,000, right? That could be pretty sweet. So anyways, it just depends on your risk profile, guys. So that's essentially how the maximizer rate works. That's basically how much the S&P needs to go up in order to double our dividend. And then the multiplier determines how much credits we get based off of the percentage that the market went up. Yep. So hopefully that makes sense. Let's see. Let's go back to the presentation. Let's continue. All right, let's talk about some benefits here. Some specific benefits. Why use an indexed dividend option rider with a whole life policy instead of an IUL? Okay. So number 1 here is you are a part owner in a mutually owned life insurance company when you have a participating whole life policy versus a profit center. This is something that one of my mentors talks about quite a bit, and he's absolutely right. When you own the whole life policy and you're a part owner in that company, you benefit from the profits of that company. That's essentially what the dividend is. Okay, it's the profit, the profit and growth of the company coming back to us as owners in that mutually owned life insurance company. Versus with an IUL, you're not a part owner in that company, and you're taking on all the risk. So you essentially become much more of a profit center for the company than if you were an owner. Now, I'm not saying that as an owner, they don't make profit off of my premiums. Absolutely. But I want them to, because those profits are going to come back to me. And right, it doesn't matter with an IUL. It doesn't matter how good the life insurance company does. You don't really you don't participate in that, other than indirectly. Maybe there's a higher options budget, because the general fund did better, maybe, or they were less expensive. Things like that. But you're not participating in the profitability of the company. It's very, very different. For me, also, this is there's far more simplicity with this, guys. You're taking a portion of your dividend, invest it in call. You're putting it into call options on the S&P 500, and if it goes up a certain amount, you can double it. If it goes up this much, you'll get 1.5 your dividend, or you might lose your dividend. That's it. That's all there is to it. We don't have to manage. Here comes the other parts of this. We don't have to worry about the rising cost of insurance, because IUL is built on annual renewable terms. So your cost of insurance goes up every single year exponentially when you get older. Do you know how expensive it is to have a term policy when you're 70, 80 years old, guys? Now, you can manage that. We'll talk about that in a second. But with whole life, we don't have to worry about that. We don't have to worry about our ever-increasing cost of insurance. In fact, as we get older, our cost of insurance goes down, technically, because with a whole life policy, those costs are level, right, throughout the entire policy, and they're guaranteed that way. That's why I love whole life. The guarantees are very, very strong and in our favor, right? We don't have to worry about getting a bill or a notice from the company when we're 75, 80 years old, saying, hey, your policy is about to lapse unless you pay $10,000, $20,000. You don't have enough cash value to cover your cost of insurance anymore, so you need to pay XYZ amount. Can't tell you how many stories I've seen like that, guys, with universal life policies. So why are we messing with this? So we don't have to worry about the rising cost of insurance. We don't have to manage the net amount at risk either. So you have cost of insurance, net amount at risk, and your cost of insurance can be mitigated by managing the net amount at risk, but you have to manage it like a hawk every single year. You need to, maybe you're increasing death benefit, maybe you're lowering it, adjusting premiums, whatever. You have to manage that, because if you don't, that cost of insurance can destroy your policy and really eat up your cash value. With a whole life policy, we don't have to worry about it, guys. We don't have to manage net amount at risk in a whole life policy. Another major benefit of using a whole life policy for this, is that a whole life policy can be paid up, guys. IUL cannot. All right. You can stop making premium payments in an IUL. It's called a vanishing premium. So when you see your illustration, you're not making premium payments anymore at 65 or 50, whatever it is. That doesn't mean that you don't have a bill due, because your cost of insurance is still going up every single year. And they're assuming that the growth of the policy is going to cover all of those expenses for the rest of your life. That's another problem with IULs. It shows the growth of the policy every single year. Market doesn't go up every single year, guys. So what happens when you hit 65, 70, 75 years old, and that cost of insurance is still due, but you have a 0 year? Where's that coming from? It's coming from your cash value, guys, especially since you're not making premium payments anymore. So you can stop making premium payments with an IUL. It doesn't mean it's paid up. With a whole life policy, you can have that thing paid up, never owe another dime to the company ever again, and your policy will still continue to grow. Just like a mortgage on your house, guys. How you can pay off your mortgage on the house, and that doesn't mean that your house stops going up in value over time, does it? No. It still goes up in value, right? You can access the home equity, you can sell it, etc. But when you pay off your mortgage, you don't make another mortgage payment. You're done, right? It's the same thing with a whole life policy. It is awesome. And with One America, you can do 20-year pay policies. You can do pay to 65. You can do pay to 70. However you want to set it up, it's totally up to you. Kind of already mentioned this. Your cash value can't go backwards. So this is where the guarantees of whole life really come in. So the main risk here is you can lose your dividends, or however much of your dividend you allocate. That's the risk. But your cash value can't go backwards because of a 0 year like it can in an IUL, interrupting that compound growth. IULs don't compound, guys. When you get a 0, you're going backwards. All right, that interrupts the compound process. All right. Later on, you can turn your dividends into a retirement income stream. All right, so that's another big promise of IULs, all this tax-free retirement income you're going to get. All right, you can turn your dividends or use your policy for retirement income as well. Now, the amount of income that you take from it, is it going to look as good on an illustration compared to an IUL? Absolutely not. That's because all the numbers are smoke and mirrors, guys. Again, life doesn't happen on an illustration. And if you're trying to utilize your policy, a life insurance policy, for the primary source of your retirement income, I would honestly say you need to rethink the priorities here a little bit, because life insurance can be a supplemental retirement income stream. It can be a fantastic volatility buffer as well, but it shouldn't be the main source of retirement income that we're trying to build here. All right. So you can turn the dividend into an income stream tax-free up to your basis. You can make withdrawals as well. You can take policy loans. You just want to be careful with it. You don't want to over leverage it. But as long as the policy has had time to mature and it's very efficient, it's grown, you have good cash value in there, you can take policy loans, not have to repay them back. Once you pass away, the death benefit will pay off your loan balance, and whatever's left of that death benefit will get paid to your beneficiaries. Just know that when you're taking those loans, that interest will compound against you. But again, as long as you're doing it responsibly, okay, you're not over leveraging it, you should be fine. That's the other benefit that IUL agents will bring up against whole life, is that you have the possibility, or the option, of doing what's called a wash loan for your retirement income, but it just doesn't look nearly as good on paper as the participating loans. And I don't see a lot of agents promoting that anyways. So moving on, we talked about the guaranteed growth rate. One America, as of right now, has a 3.25% guaranteed growth rate. There's no fee for the rider, and it can be turned on and off. So like I said, you want to do 5 years with your dividend, let it build up, and then maybe you think the market, let's say the market's been down for a couple of years in a row, and now you think the market's going to go up. All right, you could turn that rider on, allocate 50% of your dividend, 100% of your dividend, whatever, and then you're good to go. Right, and then potentially you double it. Now, I should mention too that dividends are not guaranteed, but that brings me to my next slide here. Why I love One America. Who is One America? All right, so mutually owned life insurance company. They've been in business for 146 years, guys. That is a very long time. They have a Comdex score of 95, and I have a little article here. Shout out to this gentleman for putting this together. The Comdex score is the average ranking a company receives from the 4 major rating agencies in America. That would be AM Best, Standard & Poor's, Moody's, Investors Services, and Fitch. Okay, that was kind of a mouthful, but you get the point. So high Comdex score, really, really good. And One America has a Comdex score of 95. Just a quick shout out to Lafayette as well. I love Lafayette. That was I set up my first policy with them. They have a 96 Comdex score, so good stuff. But you want to set these policies up with really financially strong companies, right? One America has never missed a dividend, guys, in 146 years. So the dividends are not guaranteed, but come on, they paid it for 146 years consecutively. And you know why? Because mutually owned life insurance companies are the best risk management companies in the world, bar none. There's nobody better than them. So they've never missed a dividend. Strong guaranteed rate, 3.25%. I love that. They offer us the indexed dividend option rider if we do want to take a little bit more risk with the policy. Again, I don't recommend it. I'm not a fan of it, of involving the stock market in my policy. But if you are going to do it in a less risky way, is how I'll put it. One America, pretty fast underwriting too, depending on age, health. Depending on the amount of death benefit involved, it could be pretty quick underwriting. You can get approved for your policy pretty quickly. And then this is kind of a side note, but they also have a really strong asset-based long-term care product that I'm working on my health insurance license right now. Once I get that, I am going to share that with you guys. It is awesome for preparing for long-term care expenses later on in life. So let's go ahead and start to wrap up. Here's the question, guys. Why buy an IUL for upside potential and downside protection when you can get the same thing with a whole life policy without all the problems? Now, one of the responses that I have had from IUL agents in the past, actually there's 2. One is, I don't know. And then 2 is, well, because my IUL earned 13% or 19% last year, some off the wall number, right? The problem with that is, okay, so yeah, IUL can do that if you're managing it really good and you're allocating to all different kinds of proprietary indexes and you're using multipliers and stuff, which you pay for are very expensive in a 0 year. So you better pray you don't have a 0 year when you have those multipliers and stuff like that turned on in your IUL, because it will really screw you up. But you're selling a long-term product based off of what it did in 1 year. Are you kidding me? No, sorry, I'm not doing that, guys. You can, if you want to roll the dice and you think you're going to get 19% on a regular basis, wrong. Not to mention that's probably a gross number. How much did it actually grow? Maybe it grew 15%. That's still good, sure, but it also depends on where you're at in the policy year. All clients did not get a 19%, right? So anyways, I'm going off on a rant here, but that's really the only response that I've had from IUL advocates to this question, is that you can get more potential growth in an IUL. Look, how much growth do you guys really need in a policy, in your stock market portfolio, whatever, before it starts to get a little shady here? Okay, like are we consistently going to earn 19%, 13% in an IUL? How about compounding at 8 to 10%? I mean, just use some, let's just use our common sense here and some basic critical thinking skills. Like, is that sustainable? Is that really going to happen? Probably not. Can it happen in any given year? Sure. But if I'm going to double my dividends, well, I just made 100% return on my dividend there. You know, I didn't double my cash value, okay, but I still doubled my dividend. What does that do to my overall policy growth? I mean, that's pretty good, right? So it's risk reward. See, at the end of the day, it comes down to risk reward for me, and the potential for the extra growth in an IUL is not worth the risk we take. It's not enough extra growth potential over a whole life policy, especially with a strategy like this, that warrants taking that additional risk. The rising cost of insurance, having to manage net amount at risk, all of the levers that can be changed, the participation, cap rates, the spread charges, like all this stuff. I don't want to deal with it. I don't. So hopefully this was helpful, guys. If you'd like more information, I'll have a link or button down below to book a call. You can visit my website, all that good stuff. If you want to have a conversation about this, I'll link to, I don't know where you're watching this, but definitely check out my YouTube channel as well for more information on IULs and how I'm using my infinite banking policies, which are whole life policies, how I design them, all of that stuff. Make sure you check it out. It's really good information. And like I said, at the end of the day, guys, take your time with this. Please do your research, get the facts, know how these things work so you can make the best decision for you, whether it's IUL, whole life with the indexing option, or neither. Maybe you just want to, maybe you're just like, okay, all these people have just put a bad taste in my mouth about life insurance. I'm just going to buy term and invest the difference. Okay. If that ends up being the best decision for you, what works for your goals, God bless you. Okay. But I just want you to do your research. All right. So anyways, I hope this helped, guys. I wish you all the best and all the success in the world, and I will talk to you soon. Take care.